Hi, I'm Veronica Wasek with 5-Minute Bookkeeping, and I help Shopify sellers to set up, organize, and streamline their financial systems, whether you're looking for DIY, done with you, or done for you financials. And in this video, I'm going to show you how to record or adjust your inventory balance in QuickBooks Online using a journal entry. In a previous video, I showed you how to track your Shopify inventory in QuickBooks Online. And many of you have asked me how to make the adjustment that I talked about in that video doing a journal entry. So I'll go ahead and show you that. So if you recall from our previous video, I had talked about the fact that in Shopify, even though you are able to track a cost for all of your different products in Shopify, the inventory reports really don't show you the inventory cost. They only show you the inventory quantities. So what we want to do then is to track inventory either in a spreadsheet or using a cloud inventory app. And what we're looking to track is the inventory quantities at the end of the month. So whether it's end of the month, end of the year, we're tracking inventory quantities times the cost and essentially coming up with $1 amount. So the total of all of the inventory cost and quantities, and tracking that in QuickBooks Online using a journal entry. By using a journal entry, you'll be able to adjust both cost of goods sold and inventory in QuickBooks Online at the same time, and I'll show you how that works. Let's take a look. We'll need to make sure that we have a couple of accounts already set up in QuickBooks. One is an inventory account, so it'll be set up as an other current asset account type and detail type inventory, and the account name inventory, and then you'll save and close. The other account is cost of goods sold. This will be an account type of cost of goods sold, detail type supplies and materials, -COGS, and the account name cost of goods sold, and again, save and close. Next, we'll need to make the journal entry. From the left, click on the plus sign, click journal entry. And let's say that we want to make this adjustment as of the end of March. So we'll use March 31st. And in our first example, we'll assume that there is no prior inventory balance set up in the books. So we're going to make an adjustment for the inventory balance, and we'll assume that the inventory balance is $10,000 as of the end of March. So we'll need to add the inventory account, and we will debit $10,000. We can enter in the description inventory adjustment. And next, we'll adjust cost of goods sold. And in this case, it will be a credit for $10,000. We'll go ahead and save and close. And when we look at the inventory account in QuickBooks, it now shows that we have $10,000. Now let's assume that we're in month 2 and that the inventory balance is now $7,500. So it has decreased from $10,000 to $7,500. Let's take a look and see what journal entry we'll make then. Once again, we'll click on the plus sign, journal entry, and now we need to make the journal entry as of the end of April because it's the second month that we're adjusting. And now we need to decrease the inventory balance. So in this case, because we need to decrease, we need to take the difference between the $10,000 that is in inventory. Take the difference between $10,000 and $7,500, which is the new balance, and that gives us $2,500, and it's a decrease. So we'll need to actually now enter cost of goods sold And it will be a debit of $2,500. With a description of inventory adjustment. Spell that correctly. There we go. And now we'll need to enter inventory. And now it's a credit. So if you recall before we debited inventory, now we're crediting inventory because we're decreasing inventory. And we'll save and close. Now when we look at the detail of our inventory account as of April 30th, we'll see the first journal entry we entered on March 31st for $10,000. And then we'll see the second journal entry we entered for $2,500, now decreasing inventory and giving us an ending balance in inventory of $7,500. Okay, now I know that the debits and credits can be confusing, so let me explain that a little bit more. Let's take a look. For inventory, when we debit the inventory account, we increase it. And when we credit the inventory account, we decrease it. For cost of goods sold, it's actually the same. If you debit cost of goods sold, it increases cost of goods sold. And when you credit cost of goods sold, it decreases it. So remember when I said that we would be adjusting inventory and cost of goods sold at the same time? And as you saw in the journal entries, when we debit inventory, we have to credit cost of goods sold. And when we credit inventory, we have to debit cost of goods sold. So looking back again at our chart, you can see that relationship, and I color coded that. So as you can see, if we debit inventory here in the blue box, we have to then credit cost of goods sold. And that's also in the blue box. And same, if we credit inventory, then we have to debit cost of goods sold. So I hope that helps you to understand the debits and the credits. But you always want to check yourself as you're making these adjustments, because sometimes you'll enter the journal entry incorrectly. So what I always recommend is to go back and look at the account balance and to make sure that it is the amount that you expected it to be, so that in case you made a mistake, then you can go ahead and fix that. Now this adjustment that I'm showing you, this journal entry system that I'm showing you, works whether you record all of the product purchases to the inventory account or the cost of goods sold account. I know a lot of people kind of have a preference either way. My preference is actually to record all of the product purchases to cost of goods sold, and then to make the journal entry and adjust inventory. But either way, as I said, it's adjusting inventory and cost of goods sold at the same time. Now, I know that some of you may be attempting to track inventory in QuickBooks on an item-by-item basis using the products and services list. This journal entry is not the right process for you to use. If you're tracking inventory at an item level, inventory is adjusted in a different way. So this system is assuming that you are not tracking inventory on an item-by-item basis and that you're only tracking inventory using a journal entry. Now, if you're curious about how to track inventory, as I mentioned before, you can use a spreadsheet or you can use some cloud inventory apps. So I will link those in the description box below for you to request a free spreadsheet from me so you can track your inventory. And I'll also list some of the cloud inventory apps that I recommend. I'm Veronica Wasik with 5-Minute Bookkeeping. If you're ready to work with a trusted and reliable financial pro, then check the description box below to learn more about my services and see if we'd be a good fit for working together. Also check the description box below for all of my free resources and the link to join my Facebook community. If this content is helping you, make sure that you comment, like, share, and subscribe to my channel so you can get all of my latest videos. And do leave me a comment because I do answer comments. And if there's any content you'd like me to do in the future, then also let me know that in the comments.